All right, this is a objective 2.2 in transaction analysis. We're going to define account and list and differentiate different types of accounts. So, an account is the basic summary device of accounting, and it's going to contain the history of all the increases and decreases to that account over its entire life in some instances or over a given year. Okay? In particular, for dividends, revenues, and expense accounts, it would be recording in particular for a reporting period. All right. Now, how are you going to classify accounts? You're going to classify it as an asset, a liability, or stockholders' equity. Notice that dividends, revenues, and expenses, they will also be placed with stockholders' equity conceptually, but they do not actually go on the balance sheet under stockholders' equity. All right. Dividends will be in the statement of retained earnings. Revenues and expenses will be in the income statement. And we only take retained earnings to the balance sheet. So don't get confused and put revenues and expenses in the balance sheet. They're classified with stockholders' equity because dividends will decrease stockholders' equity, revenues increase stockholders' equity, and expenses decrease stockholders' equity. But they do that through net income and the statement of retained earnings. All right. So we're going to learn just a few accounts here. All term, you're going to be learning more and more accounts. So we have cash, and that's pretty much what you think it is. It's cash and claims to cash. So cash on hand, but cash and checking accounts. And accounts receivable, that's what your customers owe you, typically in the next 30 days. Notes receivable, could be customers, but if you're a bank, it is what your customer owes you. But it charges interest. Okay, so notes also accrue interest. Accounts receivable, generally, they don't have any interest. Inventory, we can think of merchandise inventory, which is stuff you're going to sell to your customers. And there's many more, but those are just a few. So when you get an account name, mentally you have to classify it as an asset, liability, stockholders' equity. Here are some liability accounts. Accounts payable. That's what you owe your suppliers. So they shipped you some supplies or inventory, and now you have to pay them. Notes payable. Those would be like bank loans that accrue interest. Accrued liabilities. Um, you have a cell phone. Your corporation could have cell phones, and you're billed and you owe the money. That would be an accrued liability. Um, if you owe your employees have earned salary but haven't paid it, that'd be another example of accrued liabilities. We're really going to see these in Chapter 3. And stockholders' equity, common stock, and retained earnings, these are the permanent accounts. Okay. And then, as I said, we classify dividends, revenues, expenses technically as stockholders' equity, but they don't belong there in the balance sheet. So here is a very important skill for you to acquire. To classify an account as an asset, a liability, or stockholders' equity, and then identify the financial statement it belongs to. So all assets belong on the balance sheet, liabilities belong on the balance sheet. Stockholders' equity, you'll have revenues and expenses on the income statement, dividends in the statement of retained earnings, and the retained earnings account is on the balance sheet and on the statement of retained earnings. All right, so continuing with learning about accounts and differentiating them, once again, and I mean, I'm saying this over and over, but your students struggle with this. Dividends, revenues, and expenses, they aren't on the balance sheet. They are reset to zero each period and are sometimes called or referred to as, I'm having a little trouble with my pen, temporary accounts. Why do they reset each period? Well, some things you measure as a function of time. So let's say a friend tells you, I made 8,000 during some time period. Well, if they made 8,000 last year, you're like, I'm happy for you, but you're not really that excited. That's all right. If they made 8,000 last month, you're like, whoa, you really want to know how they made 8,000 in a month? If they tell you, hey, I just made $8,000 last week, you might be like, holy cow. And you may not really want to know what they're doing. And if they told you I made $8,000 yesterday, the first thing you might think is, was it a lotto ticket? And if not, you definitely don't want to know what they did. So the time period over which you in your personal life or people make money is relevant. And it's the same for corporations. If they make $1 million in a month, that's one thing. If they make $1 million a quarter, that's another thing. If they make $1 million a year, that's yet another thing. So that's why we reset dividends, revenues, expenses, because their measures are relevant as a function of time. And just in terms of what happens in practice, what happened? What happens in practice is I got to practice changing my pen colors here. Okay. Um, in real accounting is done monthly, quarterly, or annually, by month, by quarter, by year. In some industries, like in the mutual fund industry, there are daily closings. But financial reporting is definitely quarterly and annually at a minimum. Okay, and that's it for objective 2. We'll move on to objective 2.3.